This week on Wealth Track, are dividend-paying stocks a crowded trade? Veteran BlackRock Equity Dividend Fund manager Robert Shearer explains why this is one crowd you should be comfortable running with. Next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. A recurring theme on Wealth Track has been longevity risk. The good news is many of us are living longer than our parents' or grandparents' generation did. At least one spouse of a U.S. married couple age 65 can expect to live until 92. We should all be so lucky. The risk to this longevity, and it is a very real one, is that we will outlive our savings. A related theme on Wealth Track has been the intensifying search for income, particularly among retirees to fund their retirement. With interest rates at record lows, bonds, the traditional income source, are not doing the job. In addition, coupons on bonds are fixed. They do not grow, and they don't keep up with inflation. Stock dividends, on the other hand, can and for the most part do. As this chart from BlackRock shows, dividend income has been growing substantially over the last quarter century, while bond income has been decreasing. Dividend-paying stocks have another advantage. As this chart, also from BlackRock, illustrates, over the long term, dividend-paying stocks have outperformed the market and non-dividend payers. In bull markets by an average of more than 3% a year over non-dividend payers. In bear markets, dividend payers declined less than the market and about half as much as non-payers, and they far outdistanced the non-payers over the entire 4 decades. But past is not necessarily prologue. Has the search for dividend income become a so-called crowded trade? Are income stocks too expensive? Those are some of the questions we will put to this week's Wealth Track guest. He is Robert Shearer, the highly respected lead portfolio manager for the nearly $30 billion BlackRock Equity Dividend Fund, which he has run for over a decade, beating the market and his peers, and putting the fund in the top 3% of its Morningstar category. He has also run the much smaller BlackRock Natural Resources Fund since its inception in 1997. I began the interview by asking Shearer about the widespread perception that dividend-paying stocks are expensive.
Well, in certain sectors, like the utilities and some of the telecom, people have bid those sectors up because of their higher yield, and we're seeing expensive valuations. But if we look across other sectors, our portfolio trades at a discount to that of the Russell 1000 value, our benchmark. And so we're still finding companies that are growing their dividends, that are trading at cheaper valuations, yet still have high quality in the form of better return on assets, a better return on equity, that are less expensive.
One of the sayings I think that you have in your equity dividend fund group is that not all dividends are created equal. So talk to me about that concept. What is unequal, and what are better quality dividends and what are lesser quality dividend paying stocks?
Well, we look for stocks, one, that have very solid balance sheets first and foremost. So outside of the regulated utilities and the financials, we typically don't want to have a debt to cap above 50%. So starting with a sound balance sheet, but then we look for companies that generate free cash flow over and above their capital spending needs. We do want to have them spending money on capital programs because we do want them to grow their businesses to provide a growing dividend stream, but then also companies that are focused in the lowest quartile of cost of production so that we know our companies are going to have the best margin throughout a cycle. And typically, looking at a payout ratio of a company, you don't want to necessarily have a high payout ratio. Utilities will have it because of the regulated returns, right. But you want to have something that's below 40, 50% so that companies have the ability to increase that payout ratio over time as their earnings warrant.
Right, so that's a payout ratio as a percentage of earnings. So you want it below 40%? Is that
You know,
basically what
want
your
it a little
benchmark
bit
is,
lower,
or-
40 to 50%.
Yeah,
Seems to be an optimal ratio for the capital structure.
Let me ask you about your portfolio in particular, because the yield is under 2%, and that is lower than a lot of your peers. So why is it so low, and what is it that's preventing you from giving me a higher yield as a shareholder?
Well, we can find a higher yield. We can definitely deliver a higher yielding portfolio, but we find that those companies don't necessarily have the best capital appreciation potential. So what we're trying to do is balance that, the discipline that a dividend instills on company management with the potential capital appreciation. And we've found that it's in the second and third quintiles, which yield between 2.5% and 3.5%, that have the best price appreciation potential with less risk.
When I'm looking at the BlackRock Equity Dividend Fund, I'm not just looking at it for the dividend stream. I'm looking at it for appreciation as well. And so, I mean, do you have how do you weigh that, or do you weigh it? I mean,
we do weigh. I mean, if
okay.
we find a company that has a 0.5% dividend yield, some of the last decade, some of the natural gas companies we owned in the portfolio, like Devon and EOG Resources, only a 0.5% yield, but in our holding period, they're up 40-50%. So we'll
on the capital appreciation.
On the capital appreciation side.
Right.
So we'll balance that. And we try to focus more on dividend growth in the portfolio as well. Our 10-year track record has been 13.8%, about 4 percentage points higher than our competitor peers, and even higher versus the S&P 500 and the Russell 1000.
So that's 13.8% growth of dividend growth in the portfolio.
Right. So, and that's what we want people to focus on. We throw out examples like IBM. 10 years ago paid a 14-cent quarterly dividend, yielded under 2%. But they've just increased their dividend, I think just the end of last month, to 95 cents. So your income growth has gone from 14 cents to 95 cents a quarter. The stock's still yielding under 2%. But you've had that growth in income, and that's what we think people have to focus on with, as we talked about in the intro, the longevity and people living longer in retirement.
A lot of people, too, are looking for, current income. And so, there's that saying, a bird in the hand is worth two in the bush, and so it's a dividend in hand is worth, a dividend stream farther along. So, I mean, are there historical measures that show that actually, like the dividend growers do better than high yielders, for instance? I mean, why is that a more desirable sort of security to own?
I think studies have shown that, one, companies that initiate a dividend have the strong capital appreciation, and then companies that increase their dividend are second along that line. Those that have a high yield already tend not to have the capital appreciation potential. They might be high for a reason. The fundamentals of the company might not be that great. Capital structure might be stretched. So we were defining that, as I say, those dividend growers give you a better capital appreciation.
In your fund, it's historically also has had an incredibly low turnover. Tell me what's going on, what the dynamics are.
Part of it is we look for companies and we try to invest on the company's investment time horizon. And if you look at industrial companies, mining companies, energy companies, when you discover a deep water well, it might be 10 years before you delineate the field, put the platform in, and bring on production. These are long-term projects in nature, similar for industrial companies. And so as long as the company is meeting its goals and following the strategy that they articulate, we tend to be fairly patient holders and don't trade in and out necessarily if there's a quarterly blip.
What kinds of companies are you finding yourself investing in that might have been different than what you would have invested in, let's say, 3 or 4 years ago, before dividend payers became such a popular sector?
Well, one area that we've increasing our weighting in is the healthcare sector. 3 years ago, we knew that we had the pipelines for the drug companies were poor, not a lot of new drugs coming in. We had a patent expiration cliff that started last year with Pfizer in December, Lipitor going off patent. Other companies are facing that same patent expiration, and the companies have to pay in $90 billion into the Affordable Health Care Act, and they're only going to get the benefit of the 30 million new patients that will be covered under it starting this year and into 2014. Now that we're closer to that increased volume, we think that kind of offsets some of the pipeline issues and patent expiration issues. And so it was a high yielding sector that we are underweight, but we're reducing that underweight. And we continue to focus on staples and select industrial companies as well. Companies like Honeywell, which has been improving its operating system, Honeywell operating system, getting greater efficiencies at its plants, and also a beneficiary of reducing its dependence on the defense sector and moving more toward commercial aerospace under CEO Dave Sodi.
I'm listening to you talking about these. These are all individual company stories, but do they fit into, so how do you approach the process?
We're very much we're a bottom-up
You are bottom-up,
fund.
yeah.
And so we focus on meeting company managements, and fortunately with BlackRock running $3.8 trillion in assets under management, we get about access to just about any company we see. And so it's a learning from companies what's going on in their businesses, their competitors, that kind of focus that generates our portfolio construction.
Yep. So another area that I know that you've been started investing in as well is technology companies. And again, one never thought of technology companies being dividend payers.
Right.
So what's going on, there, and where are you finding opportunities?
Well, the companies have become, they're trading at a cheaper valuation than they have in years. They have cash on the balance sheets, and so they're starting to return that to shareholders. I think the stigma of a company that started a dividend and signaling that it has no more growth is over. And now the companies are doing it. We've seen Cisco initiate a dividend. Apple, of course, in the fourth quarter initiated a dividend. But we have companies like Intel, IBM, of course, and Microsoft in the portfolio, which we expect to see some increasing dividend payments.
Bob, you just brought up a very interesting point that once a tech company, a growth company, starts paying a dividend, the investors are just saying it's no longer a growth company, it's mature and we want out. But you're saying that in fact, it not necessarily so, and it's also an opportunity for you.
I think that stigma is over. The companies have a lot of cash on their balance sheets. They're trading at less expensive valuations than they have in years. So there's those types of opportunities.
So I have to ask you, of course, about Apple because everyone's talking about it, and it certainly had a fall from grace recently.
Right.
So what's your what are your views on Apple, and do you own it?
Well, we don't own it yet,
yeah.
but we debated it late last year. But,
and debated it means
considered it for investment because, but we kind of determined that all the growth investors had been in the stock. You had value investors buying the stock. You also had income funds buying it in anticipation of the dividend being paid. So the stock had run up to $700. We thought we were probably the last ones to come to the party, so we decided to pass on it. And we also are concerned because Steve Jobs had passed on a little bit over a year ago. Even he had his fingerprints on the iPhone 5, which was the last major product release. And so we want to see what the creative minds at Apple are coming out with before we really get comfortable to go back into the story. But certainly with the dividend being paid now, it is a candidate.
Global search for income. How global have you gone with the BlackRock Equity Dividend Fund?
Well, we've gone global because when we look at our company analysis, if the best company is not necessarily domiciled in the United States, we'll go international. So in the mining sector, we'll go to BHP, which diversified miner, all its divisions operate in the lowest quartile cost of production. We think the best miner. In the case of the financial system, when going into the crisis, we went to Canada. You can count the number of banks in Canada on your two hands, a much more concentrated industry than the 7,000 plus institutions we have in the United States. And they were able to go through the financial crisis, stricter lending standards for housing, also benefiting from a resource economy that was exporting into the growing emerging markets for natural resources. So they were able to come through the entire financial crisis without any major dividend cuts. So we kind of hit out in Canada during that financial crisis.
And what about the financials? Because of course, if you're looking for dividend payers, that was traditionally an area that people went But again, you've got this dual mandate in your fund, and where you want capital appreciation and you want dividend growth as well. So has the financial area in the U.S. offered you any opportunities?
It has. I mean, we were fortunate that we were underweight U.S. financials going into the crisis.
Right.
But we did not, when the dividends were cut, we kept some big holdings, J.P. Morgan, Wells Fargo. US.
I'm looking, actually, those are among your top holdings, right?
Unique, Wells Fargo has the benefit of cross-selling into the Wachovia branches that it acquired. J.P. Morgan, except for the black eye from the London Trail
right.
Whale office trading, really managed fairly well through the credit crisis. And U.S. Bancorp has taken the advantage of the FDIC, or Federal Deposit Insurance Corporation, to roll up some weaker banks in its service area and kind of solidify. So all of them had kind of unique organic growth. But at the current time, we are increasing our weighting in the financials. We've invested in SunTrust in the Southeast, starting to see some of its mortgage costs decline. They have other cost-cutting areas that can drive growth, and also seeing an uptick in mortgage activity as the Florida market starts to recover. Added to Fifth Third in the Midwest banking system.
Right.
Very high quality bank, trading at a cheaper valuation, and also look for them to be returning cash to shareholders as they shore up their balance sheets.
You've got GE, you've got Chevron among the top holdings. So they all have what in common? What would, if I could define a classic, BlackRock equity dividend fund holding, what would it look like?
It would be, as you said, companies that you recognize.
Right.
Diversified sources of income, and a global nature. Chevron, of course, bringing on liquefied natural gas projects in Australia, is going to be involved in also deep water projects in the Gulf of Mexico, where they've had a number of discoveries. And the big thing is a lot of the projects that they're bringing on tend to be low decline projects. You're not fighting the decline curve of an oil well. LNG, when it comes on, it's good for a 30-year period of time. So while it's heavy capital spending up front, once that is over, you have a much less capital intensity and free cash flow generation, which can be returned to shareholders in the form of a dividend. And outside of Chevron's growth capital, they tend to espouse a philosophy of returning dividends to shareholders.
And and I have to ask you, because we've mentioned a number of natural resource companies, mm-hmm. and you have run the BlackRock Natural Resources Fund for a number of years, and it's 10% annualized returns of 13.5%, which is pretty spectacular. There's a lot of talk now about the fact that this commodity super cycle, is what they call it, as you know better than I, that has lasted for the last 30 years, is over. I mean, what's your view?
Well, I think it has slowed. China has slowed down, and that was the dominant driver for growth. Europe obviously has been in recession and not growing. Our economic recovery has been sluggish. I think once the global economies reemerge, though, there's not enough, there is going to be increasing demand for commodity using as this middle class gets greater wealth. They buy automobiles, refrigerators, air conditioners, all that's going to increase the metal intensity. So I see that this is just a temporary cyclical slowdown in a secular theme that's going to be positive for the natural resources. Okay,
so that's very interesting, because there are a number of people who obviously are saying, taking the opposite tack. The whole concept of demand for dividends mm-hmm. is, a lot of people, that these styles of investing go in and out of favor. We've come through this, horrible financial crisis, so that there are some out there who are saying, this is a temporary, fad. And that the dividend payers, that's really not where you should be. And so what's your thought? Because you think that this really has legs, the demand for growing income streams.
Just the demographics of people that are retiring. Your fixed income investments are returning very little. Out through the 10-year, you're actually probably negative real returns if you look at a 2% inflation rate. And in many cases, if you look at your corporate bond yields, the dividend yields are substantially above what you're getting on your 4 to 7 year bond at a corporation. And we found where fixed income payments, of course, don't grow. And so if you do have inflation, you're going to erode that purchasing power. Dividends have been able to show 1 to 1.5% growth outpacing inflation.
Which is so interesting. You mean over time,
Over time,
dividends have outpaced, dividend growth has outpaced inflation. So you're protecting and your purchasing power,
Right.
and actually growing your purchasing power
purchasing
with
power.
dividends. Yeah.
So I think there's going to be huge demand for this because obviously defined benefit programs are pretty much non-existent these days.
Right.
Social Security, whether or not it will be fully available or be means tested, that could be at risk for younger generations. So dividends are going to have to provide more of that income, which, as we talk about, a couple, men living, reaching 65, one has a 50% chance of living to 92
Right.
years. A lot of time, and people are increasingly getting worried about outgrowing or outliving their income.
And I know this is a theme that BlackRock is really is emphasizing as well, this longevity, and it's a global phenomenon as well. It's not just a U.S. phenomenon. So, as far as again, the demand for dividends is concerned, is there something different that you're having to do in order to, again, to compete with the demand that's out there? Do you envision your strategy changing at all, or going into other areas that you haven't traditionally been in?
No, we're just going to still focus on large cap companies.
And why focus on large cap?
Just the stability. They've
Right.
gotten to that point where their operations and their balance sheets are there. Leading brands that people come and purchase,
Right.
and then also are being adopted by the emerging markets as they get greater wealth, tend to adopt some of the leading brands that we have in our country. So we think it's a secular theme, and the growth in income, I think, is just a necessary to meet those retirement needs, because the other sources are not there. In fact, if you have any maturity in your bond portfolio, when rates tick up, you have the risk of principal loss.
Right. So what happens when rates tick up to these dividend growing stocks and the kinds of companies that you invest in?
I think they'd have to grow pretty substantially before they are a competitor to the dividend companies.
Right.
I think dividends are something that are going to be coming back into vogue just because of the demographics, and the companies have the ability to do it because the payout ratio has actually dropped for almost over 50 years, and it's at one of the lowest levels, and we have more corporate cash on balance sheets, so the companies can afford to pay dividends.
So there was another question along those lines that I wanted to ask you too, Bob, and the fact that earnings growth has really slowed tremendously. I think it's going to be about 1% or something, according to Bloomberg this year. So how is that going to affect dividend payouts? Well,
I think since your earnings growth is not going to be there, the potential for capital appreciation, and we have gone back to the old highs in
Right.
the market. So more of your return might have to come from the form of a dividend, and with if payout ratios move up, we might get to the point where we're going to see half your total return. Actually, during the decade of 2000, all your return came from dividends.
Right.
And over history time, we see 50-60% of the returns came in the form of dividends, and I think we're probably moving back to that type of level.
Oh, interesting point. All right, so the one investment for a long-term diversified portfolio, we always ask our guests this question: what would you have us own in a broadly diversified portfolio?
As far as individual stocks, or
Sure.
Sure. I mean, the things that we're looking at are like some of the industrials. I mentioned Honeywell
Right.
before, which is improving its margins in aerospace, energy efficiency, security, diversified revenue streams, and as I say, are getting tremendous margin improvement. We also like Comcast, the largest cable supplier, cable television supplier in the country. Made a very good acquisition of NBC Universal, which is providing product into their programming, as well as their theme parks are doing very well.
Well, Bob Scheer, it's really a treat to have you back on Wealth Track.
Okay.
And thank you, representing two funds, BlackRock Equity Dividend and also the Natural Resources Fund, both of which have terrific long-term track records. So thanks for sharing your current thoughts with us.
Okay, thanks for having me.
John D. Rockefeller is quoted as saying, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." Well, I hope in reality he had many other sources of happiness as well, and certainly the incredible philanthropy of his family has given countless Americans great pleasure. But from an investment point of view, that focus on dividends is not misplaced. Cash counts, and compounding cash adds up rapidly. So this week's action point is don't underestimate the power of dividends. If reinvested, they have phenomenal compounding power. And if they are growing, they offer valuable purchasing power protection. We agree with Bob Shearer that not all dividends are created equal, but top quality companies with a history of growing dividends have more than proven their worth over the years. Well, next week we are going to think contrarian, an exclusive interview with great investor Robert Kleinschmidt of the Tocqueville Fund. Where is he finding deep value in today's market? And if you've missed any of our past great investor or financial thought leader guests, you can find them on our website, wealthtrack.com. You can also see additional and extended interviews with Bob Shearer, among others, in our WealthTrack Extra feature. In the meantime, thank you so much for watching. Have a great week and make it a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.